The second key component of your financial model is your cash flow statement. It's a very important document. It's rather simple looking, but it's very powerful because it tells you how much cash you need and how long it will last. Again, it's a statement. You should do it by the month. You have yearly summaries, and you want to do it as long as your pro forma income statement goes. So if you've done it for 3 years, you want a cash flow or a statement to do the same. It has 3 major sections. The first section is cash flow from operations. Cash flow from operations is just that. Revenue minus cost of goods sold minus expenses. Whatever that number is left over, often a negative in a startup, goes there. It's a negative cash flow out. It means we're not going to be bringing in or negatively from operations. The second segment is cash flow from investing activities. Now this is cash flow that you would spend on inventory, on buying a warehouse or any other capital expenditure. And it may be out or in. Maybe you've reduced inventory so you're actually getting in some money from it, or you've sold it a piece of equipment or a domain name. But generally that's a pretty simple component. It's inventory, anything major you have to buy, and it's a cash flow out. The last section is cash flow from financing activities. This is any cash flow into the company or out from selling stock, from selling bonds, from buying back bonds or buying back stock, but anything to do with really that component for it. And generally in a startup, this is going to be a very simple one. It's going to show where do you raise money, what time and how much. And that when you balance this all out, there should never be a negative amount sitting in your cash flow balance. So if you take whatever you have your starting month amount of money and you do minus or plus cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, there should be a positive number left over in your bank accounts after. If you're hitting negative, then you need to go back to your forecast and really decide, can we reduce expenses? Do we need to raise more money or what have you? So it's a really useful tool to do cash flow forecasting on that.